It's just these are the rules that make up the rules of conduct. So remember, I talked about the three aspects of the generally accepted accounting principles. So we talked about responsibilities, and the most important rule out of there is independence, right? So we talked about that. Then it's another set of rules. The performance principle deals with the conduct of the audit, right? So the goal here is that the auditor provides reasonable assurance. And so what the performance principle is dealing with is how the auditor goes about, what are the rules that they have to follow to go about conducting an audit, obtaining evidence, to be able to provide an opinion, a reasonable assurance about the financial statements. So the performance principle covers planning and supervision. So when we talk about engagement planning, we'll talk about this more, what the auditor's responsibilities are. So, you know, staffing the job with the appropriate level of people, staffing the job with someone who has experience and expertise in a particular area. So if you're going to go out and audit a broker-dealer, you should have an engagement team that has experience. At minimum, the partner and the manager. And the senior should too, but at a minimum, the partner and the manager should have expertise or experience auditing broker-dealers. Right? So that's the planning and supervision and the preparation of the audit. Materiality. We'll talk more about materiality when we cover that in a couple of weeks, but the auditor has to take that, they have to consider that, because you're saying that the financial statements are free of material misstatements. You have to define what materiality is, and there are benchmarks that auditors use to define that, and we'll talk about quantitative versus qualitative materiality. Risk assessment, huge. Risk assessment, audits are risk-based audits. The PCAOB, in selecting audit engagements to review, risk is the driver of that. They identify those audits, engagements that carry the highest risk. So we'll talk more about risk assessment in a few weeks, but basically you have to be able to understand where the risk is and to develop your audit approach around those areas that present the greatest amount of risk. And then audit evidence, which we'll talk about when we talk about audit planning in a little bit. So sufficiency. You have to have sufficient and appropriate. Sufficiency deals with the quantity, and appropriateness deals with the quality of that evidence. And I'll go into that more when we talk about the performance of an audit. So we'll come to that as we go throughout the topics of talking about the audits of the revenue cycle, the audits of